Welcome back to capexforextrading.com. In this video we're going to focus on moving averages, and we're going to show you how you can use them to identify a trend and also how you can use them to provide support and resistance in order to get into those trends. Now, for those that are new to moving averages, their calculation is actually quite simple. What the system will do is take the closing prices of X amount of trading sessions, add them all up to generate a total, and then divide them by the number of trading sessions to generate a moving average. So, for example, what I have here is a 20-period moving average. So what the system will do is take the last 20 sessions, add the closing prices of all those 20 sessions up together to generate a total, and then that total will be divided by 20 to generate a reading for the moving average line. And that's exactly what we've got here. There are two types of moving averages, the simple moving average and the exponential moving average. So let's focus on this 20-period moving average to define the difference between the two. So the simple moving average is basically a standard calculation that gives equal weight to all the trading sessions when it's calculating its formula. So in fact, it provides us with a true average of the previous 20 sessions. The exponential moving average does exactly the same thing as the simple moving average, but it gives more weight to the last few sessions so that this line here becomes a lot more responsive to quick change in market prices. So for example, if this black line here suddenly dropped all the way down to here because of some news, then the simple moving average will not be good enough or will not give us the right reading for that quick change and that big drop in market price. It is the exponential moving average that will give us the correct reading because it gives more weight to the last few sessions in the trading chart that we see here. Now, moving averages can be used in a couple of ways. The first way is to use the moving average line as a bouncing tool, and that's exactly what we've got here. So we use the bounce off the moving average to get into a trend. So the first thing we need to establish is the market direction, and we can see that there is a clear uptrend happening from this point up until here. But if we're looking into this price area here, we're not sure whether this uptrend is strong enough. But what we do have is an upward sloping moving average line. So when prices are moving upwards and then move into the moving average line, but the moving average line is still sloping upwards, that is a key area for us to get into that trade, into that uptrend. So the bounce happens in this area here, and our profit target is the previous high, which is here. So if I mark that target with a horizontal line in this area, you can see that it's been taken out by this big long white candle here. The other way that we can use moving averages is by adding another moving average to the mix. So we already got a 20-period moving average here. So what we're going to do is add another moving average to the mix, but we're going to change that to 10 periods and going to change the color to dark blue. So what we're looking for in this example is a crossover between the two moving averages. So that's exactly what we get here in this area. You can see that the 10-period moving average has crossed over the 20-period moving average. If we're trading in the opposite direction, then we need the 10-period moving average to cross under the 20-period moving average. But in this example, we're looking at this uptrend here. So we've got an upward sloping 10-period moving average. We've got a 20-period moving average that is slightly lagging behind, but it's still sloping upwards. So the only thing we're really looking for is a crossover between the 10-period moving average and the 20-period moving average to confirm the uptrend that began at this level here. We have a great example of one of our other videos of how we use this crossover to confirm uptrends with other indicators. So if you want to look at our commodity channel index indicator video, then please do so for a bit more of a clearer picture of how this indicator can be used. Now lastly, for some reasons, a lot of traders seem to think that there is a magic number in moving averages. So they seem to think that the 10-period moving average is the best. Some people tend to think that the 20-period moving average is the best, but this is not true. There is no magic number to moving averages. It really depends on the strategy that you are trading. So for example, if I delete this indicator and this indicator here and add a new moving average of, let's say, 200, Okay, now we can see that the 200 moving average is less responsive than the 10, 20, 30, 40 or 50 moving averages because it takes into account many more trading sessions. But the actual theory is exactly the same. So we've got a bounce of the 200 period moving average here, and we've got a bounce of the 200 period moving average here. In fact, we also got bounce here as well. So whilst the 200 period moving average would not take into account this bounce or this bounce here when we're trading in a downwards direction, it does take into account long-term bounces, which is here, here, and here. So just make sure that when you are using moving averages that you're using A, the correct time frame, and B, the correct period setting for those moving averages. So as always, if you have any questions or comments, do let us know. Otherwise, please follow our YouTube channel or follow us on Twitter, Facebook, LinkedIn, or Google+, and we shall see you for the next lesson.